Let's welcome now to the Open Daniel Ortizi, who's joining us from the Stock Doctor. So, Daniel, good morning to you. I don't think we should spend much time on the Fed, on the macro, because we'll have that decision and the dot plots by this time tomorrow. So, instead, let's talk about stocks. We love them. 2024 was a banner year for many investors, but not all stocks. Where were the weak points for you?
Yeah, good to be with you, Nadine. Oh, definitely. If you look at, I guess, just a simple 1 year total return by industry, you'll quickly see the winners and losers. You've got tech stocks in the ASX returning around 50%. Very other end of the spectrum, energy and materials are down 20 and 10% respectively. So it has been a very diverse year for stock returns, and sentiment has driven returns heavily in different industries. And of course, tech has been where most of the earnings growth has been. But even if you look at something like financials, banks have continued to defy expectations, continue to move higher, mostly driven by multiple expansion with little earnings growth. So it has been a very strong year for investors in 2024. I think the return profile can look different in 2025, and perhaps some of those, I guess, unloved stories, stocks we think are quality businesses, but have had either the macro go against them or some idiosyncratic issues in 2024 can certainly bounce back in 2025, and most importantly in the years ahead. That I guess continuous compounding is front of mind for us, Nadine.
Okay, so can we get specific? What stocks in particular do you think might come to the fore in 2025?
Yeah, look, certainly starting off in the energy sector, one that's obviously had a tough year due to the macro, and we still think the macro picture does look quite challenging given the bearish positions on oil at the moment. But Santos, to us, is the stock that looks relatively interesting. The key reason why has been its recent changes, I guess, to its capital management policies, particularly which will kick in once the investment programs start to roll off. So, Santos obviously got multiple projects on the go at the moment. Some which were born to them by the Oil Search merger, and some which have been in their portfolio for a long time but have been delayed, like the Barossa project, and most importantly. So as we start to see the investment in these projects roll off, we're going to see CapEx, at least on a consensus basis, go from around 2.7 billion to just over probably 1.3, 1.5. And that, windfall just in terms of less spending, I think is going to flow through to capital returns, either through share buybacks or dividends, and investors will reward that handsomely. We've seen what happened, I guess, when Woodside announced their recent multiple acquisitions. The market clearly has not supported that. It thinks it's adding gearing at a time where the macro could be challenging, and it's not willing to support that added financial leverage. It wants companies which, are reducing gearing, reducing their investment phases, and more shareholder friendly. And Santos is the clear winner there, in our view, Nadine.
Okay, so Santos is one. Let's get across Pilbara Minerals as well, because, yeah, it's been a pretty bad year for lithium.
Of course, and a stock I follow more closely. I've spoken about it many times on the show as, I guess, someone who's researching the lithium market quite closely. And I guess we haven't really seen the price response that many analysts thought we would see in 2024. It's been driven by just greater than expected supply response out of particularly Africa, Chile, and China, which are all now major producers on the world stage. So, despite, I guess, the low price and the lower for longer, I guess, mentality amongst producers, there hasn't really been a cutback by most major producers around the world. But we've actually started to see that in recent months. Pilbara itself announced the closure of its higher cost plant operation, the Ngarju plant. So now that we're starting to see some supply, not only, I guess, cancellations in terms of growth projects, but actual cuts from the market, from these large producers, I think that's going to lead to a price response in the short term. We also know that lithium as a chemical doesn't have as long of a storage life as your traditional commodities, particularly those in, the precious or base metal market. So, we think that supply cut can be a little bit more impactful to prices in a shorter amount of time than, say, other commodities. And the reason why we like Pilbara Minerals is just the quality of its operations, its management team, and obviously it's still got over $1 billion in net cash to support it through a difficult time, despite the fact that it's actually making cash on a pure operating margin basis. It's the investments and the ramp up of the P850 investment project was kind of been a drag on cash flow. So we see a similar story to Santos, We see, lower investment spend in the year ahead, a potential increase for prices, and really the recent sell-off due to some of the index changes, Nadine, in our view,
Mm-hmm.
has kind of given Pilbara, a bit of an opportunity, or shareholders in Pilbara an opportunity, whereby the first time for a long time, it's actually traded on a valuation basis close to its peers. It's always traded at a premium. We think it should trade at a premium, and that's why we have more conviction on the buy right now.
All right. And if you look past resources, because those are, both resources linked companies, anything with a better growth profile, a growth stock that you think might hit its strides in 2025?
Yeah, well, a fallen darling really in the tech space has been Megaport, and I guess this is what happens when you're unable to meet very lofty consensus expectations. Megaport's a company which has grown revenue, easily 20% per annum compound for quite a while now, and that growth in revenue is starting to slow down materially. A key driver in the slowdown of growth has been effectively, its prices that it put up in 2022, 2021 to kind of help buffer it in a really weak market for capital raisings and market support. Megaport put up their prices to help improve their cash flow, reduce reliance on the market. Short-term sugar hit for the company, but now we've started to see some customers churn away or their usage and bandwidth drop off considerably. So the company's starting to address that. It's got multiple initiatives in place. It's even had a different kind of sales strategy or go-to-market strategy under new CEO Michael Reid. So there have been some factors changing within Megaport, but we still think the tailwinds in the industry overall, in the interconnection market for data centers is growing significantly. Many people think this is a market which is going to grow at around a 15% CAGR over the next 10 years. So we still see tailwinds in the top line. We actually think that consensus has finally been more realistic with their revenue assumptions going forward, and the company did kind of cleanse that at its AGM. And we think the company's now at a base of expectations where it's actually skewed to the upside, and that's been the first time for a very long time for this company. So we think it's a good quality company. It's a company which has, I guess, a forward-moving advantage, being one of the first in this space. And we think, the expectations look somewhat conservative for the next few years. And, if it's able to beat those revenue expectations, won't be surprised to see this stock re-rate really quickly, Nadine, or if not, receive potentially some takeover interests.
Well, Daniel, I think you've done a great job of giving us some food for thought for 2025 with 3 stocks to watch. As an investor, are you optimistic? Because we do have a lot of moving parts with tariffs. Just a general comment on where you're expecting the local market to head, because of course we're so dependent on China as well.
It's a very good point, Nadine. And I think there is a conversation, and there's a great point, I guess, on both sides at this time, given the uncertainty. I think we actually had this conversation in our team yesterday. Even if you don't have perhaps some of the positive economic growth tailwinds ahead, which many people are forecasting, particularly for the US. And typically when we see strong US markets, it kind of rolls over and rolls into other equity markets around the globe. But we certainly think that the China-reliant sectors in the ASX, they've underperformed. Energy materials have underperformed. So the base, or I guess the starting point for that in 2025 wouldn't be our focus. Our focus is definitely on overall economic growth, particularly in the US, and whether or not that will be beneficial for I guess sentiment more broadly. I think it's certainly a sentiment-driven, I guess, allocation strategy at the moment, Nadine. And we've been speaking about the fact that you simply just can't be under allocated to equities at the moment, given how strong the market has been. So until we see some form of exogenous event that kind of shocks the market, I think investors and asset allocators are still going to be dripping money into equity markets. We've seen record flows in the US as well. So until financial investors have a reason to allocate capital elsewhere, and they simply just don't at the moment, particularly with the risk that we have in something like bonds with the US, like you mentioned, with potential trade wars, tariffs. What does that do to inflation, interest rates? If interest rates are heading up, no one wants to own bonds. So at the moment, equity seems to be the asset class, the place to be for asset allocation. We just need to see an exogenous event, and that could change very quickly. But our view at the moment is momentum will continue to drive it higher, Nadeem.